Tonight, I want to reveal why the money sitting in your bank account may not fully exist in the way you imagine. This idea sounds dramatic, but understanding it is essential because your financial decisions depend on knowing what money truly represents. Imagine 20% of Americans showing up tomorrow morning asking to withdraw their entire bank balances at once. Within hours, the system would freeze because banks simply do not hold enough physical or digital reserves to meet that demand. That outcome is not a theoretical collapse scenario, but a mathematical reality built directly into how modern banking functions. My name is Max, and I have spent years studying how money flows, how banks operate, and why these mechanics rarely get explained clearly. If you want to understand the financial world at a level most people never reach, stay with me for the next few minutes tonight. By the end of this breakdown, you will understand how banks create new money and how that process shapes your everyday financial life. Most people think banks simply store deposits, protect them, and wait for customers to withdraw funds whenever they choose. But the modern banking system does something far more surprising and powerful than merely holding your savings safely. Banks are not just storage facilities for existing money, because they also create new money every time they issue a loan. That statement is not speculation, because major central banks have published clear explanations confirming how this mechanism actually works. For example, the Bank of England reported that nearly 97% of money in the United Kingdom exists as bank deposits. Those deposits were mostly created by commercial banks the moment they made loans to households and businesses across the economy. This means only a small fraction of total money supply comes from physical cash printed by government institutions or the central bank. Understanding this distinction matters because your daily transactions involve digital money that banks manufacture whenever credit expands. When you apply for a mortgage or business loan, the bank does not search its vaults for funds deposited by other customers. Instead, the bank simply types new numbers into your account, creating fresh purchasing power that did not exist a moment earlier. This process is known as loans create deposits, and it reverses the idea many people learned in outdated school textbooks. In older explanations, banks first needed deposits before lending, but modern banking now operates through an entirely different logic. Banks decide whether a loan is profitable and safe, then create the deposit instantly, expanding the total money supply in the system. After creating the loan, the bank checks capital requirements and regulatory constraints rather than worrying about physical reserves. In the United States, reserve requirements were reduced to zero in 2020, meaning banks no longer need to hold mandatory reserve percentages. This change was permanent, confirming that reserves are no longer the primary limit on how much credit banks can create each year. The real limitation today involves bank capital, loan demand, and regulators monitoring whether institutions can absorb potential losses. But as long as loans appear profitable and rules are met, banks can continue expanding credit far beyond their physical cash holdings. This system creates a world where most new money only appears when someone takes on debt and commits to repaying it over time. Because loans come with interest, borrowers must repay more than the amount originally created by the bank during the lending process. If a bank creates $100 and charges 5% interest, borrowers owe $105, not just the original amount. However, the additional $5 does not yet exist, meaning new borrowers must take loans so extra money enters the system. This creates a perpetual cycle where debt must continually expand so people collectively have enough money to repay previous obligations. If every American suddenly tried to pay off all debts simultaneously, most of the money supply would disappear from the economy. That outcome would freeze business activity, collapse consumer spending, and create enormous economic instability almost instantly nationwide. This relationship between money and debt is fundamental because it explains why inflation steadily rises over long periods of time. When banks continually create new money through lending, more dollars chase the same amount of goods available in the real economy. As purchasing power spreads without a matching increase in production, prices naturally rise and each dollar buys slightly less each year. Inflation becomes a predictable feature of the system rather than an accidental outcome caused by temporary policy decisions. People who own assets like homes, stocks, or businesses often benefit because inflation tends to push those prices upward over time. Meanwhile, workers relying mainly on wages struggle because incomes usually grow slower than the rising costs of everyday living. This imbalance contributes to widening wealth gaps across America as asset owners accumulate gains faster than wage earners. But this dynamic did not start in recent decades and actually traces back centuries to the early days of gold storage practices. In medieval Europe, people deposited gold with goldsmiths who issued receipts allowing owners to reclaim their metal whenever needed. Over time, goldsmiths noticed most customers never withdrew gold simultaneously, leaving large reserves untouched for long stretches. Realizing this pattern, goldsmiths began issuing more receipts than gold in storage, effectively creating additional claimable value. These extra receipts acted like early money because people trusted they could exchange them for gold despite being unbacked. This technique became the foundation of fractional banking, a system where multiple claims exist on the same underlying assets. Throughout history, moments of financial panic exposed this structure whenever large groups attempted to withdraw funds simultaneously. Bank runs during the Great Depression and the 2008 crisis revealed how little liquidity banks truly held relative to obligations. Governments responded by creating institutions and emergency programs designed to protect public confidence rather than redesign the system. Central banks became lenders of last resort, whose primary goal is ensuring banks survive shocks even when depositors fear losing access. When commercial banks face liquidity shortages, central banks inject emergency funds to stabilize markets and prevent widespread panic from spreading further. Their role is often misunderstood because they focus less on protecting individual depositors and more on preserving overall financial stability. Stability in this context means maintaining confidence so people continue using bank deposits even though those deposits are mostly created through lending. Without public confidence, the entire system would unravel because money depends heavily on trust rather than fully backed reserves. This trust-based design becomes even clearer when examining global rules established by the Basel Committee in Switzerland. 1. The Basel regulations determine how much capital banks must hold, how risky assets are measured, and how lending volumes get restricted. These rules are crafted by international regulators who are not elected, but influence nearly every aspect of global banking behavior. Countries across North America, Europe, and Asia voluntarily adopt Basel standards because financial markets are interconnected worldwide. The committee's decisions ultimately shape how easily banks can create credit and therefore how quickly money supply expands. Even nations with different reserve rules still follow Basel frameworks because capital standards now dominate modern banking constraints. This shows how deeply coordinated the global financial architecture has become, even if most everyday Americans rarely hear about it. While these regulations guide banks, the broader economy still depends heavily on individuals constantly taking loans to generate money. Every mortgage, car loan, credit card balance, and business credit line adds new money into circulation through the lending mechanism. If Americans suddenly avoided all new debt, the flow of fresh money would shrink dramatically and economic activity would slow sharply. Businesses would struggle, spending would decline, and many financial institutions would lose a core source of revenue and liquidity. The system's survival depends on a steady rhythm of borrowing because credit expansion supports consumption, production, and investment. This reliance means individual households effectively serve as both participants and essential fuel within the financial machine. You are encouraged to keep borrowing not only because banks profit, but because the economy requires continuous credit creation. This theme becomes even more important as the world shifts toward advanced digital financial technologies and programmable money. Central bank digital currencies, or CBDCs, represent a future where money becomes software rather than simply numbers in bank accounts. With programmable money, central banks could theoretically adjust interest rates, spending permissions, or expiration dates on digital currency. Supporters argue this increases efficiency, reduces fraud, and helps deliver government benefits more accurately and instantly. Critics warn that programmable features could enable overly centralized control and reduce individual privacy within financial systems. Regardless of viewpoint, CBDCs will likely change how banks create credit and how citizens interact with money every day. They could streamline loan approvals, tighten transaction monitoring, and alter the balance of power between private banks and central banks. As these technologies develop, understanding the origins and mechanics of existing money becomes even more important for the public. One overlooked component of today's financial landscape involves credit scores and how they shape borrowing behavior across America. Many young adults are advised to take credit cards or small loans, even when unnecessary, simply to start building credit histories. This advice persists because credit scores reward consistent borrowing behavior rather than complete financial independence from debt. If you pay off a loan extremely quickly, the scoring algorithm may interpret that as limited borrowing activity and reduce your score. If you maintain no credit accounts at all, your score often falls because the system cannot measure your reliability as a borrower. High credit scores therefore do not prove wealth, but instead signal that you regularly take debt and repay it on schedule. This framework encourages long-term indebtedness, keeping consumers tied to financial institutions for decades through recurring loans. Similar patterns appear in mortgage structures where 30-year loans keep households attached to both lenders and rising interest obligations. The score becomes a reflection of how profitable you are to lenders rather than a full measure of financial well-being. Employers, landlords, and insurance providers rely on these scores, reinforcing how debt permanence becomes a standard expectation. This creates a loop where maintaining debt seems necessary to participate fully in modern economic and social systems. When people internalize this expectation, they accept borrowing as a normal part of everyday financial life rather than a strategic choice. The deeper truth is that credit systems are designed to keep borrowing levels stable, so money creation continues smoothly. Because new loans create new deposits, banks rely on consumer debt behavior to sustain their core business model. Understanding this helps explain why financial education often overlooks the mechanics of money creation and focuses more on credit use. The system becomes clearer once you realize lending drives money supply, inflation, asset prices, and economic growth simultaneously. People who understand these mechanics can protect themselves better by managing debt intentionally rather than passively following mainstream guidance. They also recognize how rising interest rates, tightened lending standards, or reduced borrowing can shrink money supply dramatically. Shrinking money supply often leads to recessions because fewer dollars circulate through households, businesses, and financial markets. See, every economic boom or downturn is closely linked to how aggressively banks are creating credit or limiting new lending opportunities. This perspective transforms financial news stories from confusing headlines into understandable reflections of credit expansion cycles. Once you see these patterns, you realize the economy behaves like a living system, constantly breathing money in and out. The question becomes not whether the system is broken, but whether people truly understand the rules shaping their financial reality. Knowledge gives you clarity, and clarity gives you control, especially within a system built on confidence, borrowing, and constant money creation. Many people feel overwhelmed by financial complexity, but the truth becomes surprisingly simple once you understand how banks create money from debt. Every dollar circulating today exists because someone previously borrowed money and agreed to repay it with additional interest later on. Even government spending often relies on issuing bonds that banks purchase using newly created credit instead of existing taxpayer savings. This means public debt and private debt both connect back to the same underlying mechanism that expands money supply through lending. When policymakers discuss stimulating the economy, they frequently refer to encouraging more lending to accelerate credit-driven money creation. Lower interest rates make borrowing cheaper, which increases loan demand and expands the flow of new money into daily transactions. Higher interest rates slow lending, reduce money creation, and can trigger recessions as fewer dollars circulate throughout the economy. This relationship explains why central banks carefully adjust interest rates to influence borrowing behavior and overall economic momentum. But despite these powerful tools, the system still depends primarily on individuals and businesses deciding to take on new debt. Without active borrowing, the economy cannot generate enough new money to support growth, spending, or stable employment levels. This dependency reveals how deeply money, credit, and economic activity are intertwined within modern financial structures worldwide. People often assume money supply grows because governments print bills, but physical cash represents only a tiny portion of total currency. The vast majority of money exists as digital balances recorded on banking servers and created instantly whenever credit expands. These digital balances shape your purchasing power, your savings, and the prices of essential goods across every sector of life. When credit expands rapidly, asset prices surge, benefiting investors and homeowners far more than renters or wage-focused workers. Iana, this dynamic accelerates inequality, creating financial environments where opportunity depends increasingly on existing assets rather than income. People who understand this often prioritize acquiring appreciating assets early, instead of relying solely on salary growth over time. This mindset shift can dramatically change financial outcomes because it aligns personal strategy with how the system fundamentally operates. Meanwhile, many Americans struggle because they were taught outdated ideas about saving money without learning how money is actually created. Saving alone becomes difficult when inflation consistently erodes purchasing power faster than wages typically increase each year. Understanding these dynamics empowers you to navigate the system intentionally rather than feeling confused or discouraged by rising prices. It also helps you see why banks market credit products aggressively, since lending directly expands the money they generate as profit. From mortgages to personal loans, each new approval adds fresh digital dollars into circulation and boosts bank earnings simultaneously. This creates aligned incentives where banks thrive when people borrow steadily and repay reliably without becoming entirely debt-free. Credit scoring reinforces this cycle by rating borrowers primarily on their willingness and consistency in taking and managing debt. The score signals how profitable you might be to lenders, influencing access to housing, employment, and insurance opportunities. This creates a world where remaining debt-free can actually limit your options despite seeming financially responsible on the surface. Many Americans do not realize this until they face challenges renting apartments or securing affordable insurance rates with low credit scores. The system rewards predictable borrowing patterns because predictable borrowers help maintain consistent credit creation for the economy. Once you understand this relationship, the design of modern finance suddenly appears far more intentional than previously believed. You begin to realize the system is not malfunctioning but functioning exactly as built, relying on debt to sustain growth. Every loan becomes a gear in a larger machine, spinning new money into existence and keeping economic activity moving forward. Recognizing this does not require fear, but awareness, allowing you to make informed decisions rather than follow assumptions blindly. Awareness helps you avoid unnecessary debt, choose loans strategically, and place savings where inflation impacts you less severely. It encourages building assets, improving financial resilience, and understanding how credit cycles affect long-term economic conditions. With this perspective, news about interest rates, inflation, or banking policy becomes understandable instead of confusing or overwhelming. You gain the ability to interpret financial shifts and plan accordingly because you finally understand the system's underlying structure. The purpose of this breakdown is not to frighten you, but to empower you with clarity about how money truly enters existence. When you understand the mechanics behind the system, you stop guessing and start making decisions that genuinely support your future. If tonight's explanation reshaped how you view money, consider subscribing and sharing your thoughts so more people understand these mechanics.